Next week, the Federal Reserve is about to make a decision that could really shake up your finances. So what you need to know now about the June 12th meeting and their change in plans. You see, we were told at the beginning of the year that there'd be at least 3 reductions in the rates by the end of the year.
Yeah, that's what they said.
But based on the last few reports, we're now being told not so fast. And there have even been hints of potential increases in rates.
I knew it.
So most of the general public is really on pins and needles, primarily as they wait on the sidelines, thinking their dream home might move further from their grasp if rates go up again. But the Fed is likely to do nothing next week.
Nothing.
And this inaction might seem like a relief to many at first glance, but it's far from it. You see, if the Fed keeps rates unchanged, we're looking at mortgage rates remaining stuck about, between 6 and 8%. I think we're 7 right now-ish. But it's not just mortgages that this decision impacts. It also affects auto loans, credit card debt, the stock market, and even cryptocurrencies. We could see this move ripple through the economy via higher borrowing rates, stagnating the housing market growth, and then overall just, putting a squeeze on your wallet.
Squeeze. Oh, poop.
But why is the Fed just sitting on their hands? Well, plain and simply, because inflation is still the monster hiding under your bed. After a very scary spike in early 2023, recent reports show only minor improvements. And the Fed can't risk cutting rates yet because they don't have enough consistent data to prove inflation is under control. So we're left in this uncomfortable limbo while everything from your mortgage to your investments just sit there and hang on the balance. Let's break down why it's so tricky for the Fed to lower inflation or even control it at all.
I can't control it.
I can't control it.
I can't control it.
First, the basics. When the government needs money, it doesn't just print money like most people think. No, they also borrow money by using IOUs, known as Treasury securities. And these come in really 3 main types. There's Treasury bills. These are short-term IOUs that mature in, a year or less. And then there's the Treasury notes. And these are medium-term notes that mature in 2 to 10 years. And then there's the Treasury bonds. These are long-term notes that mature in up to 30 years. And it works like this. Investors, including corporations, including other countries, and then your everyday average Joe, buy these securities, these IOUs, that as a result lend money to the government in exchange for interest payments over time. Now, the interest rates on these securities are influenced by the Federal Reserve policies. So when the Fed changes its key interest rate, it indirectly affects the interest rates on these government notes, this government debt. And this is crucial because higher interest rates mean higher borrowing costs for the government, which means they have to use more of their own money to pay back their debt. Kind of a crazy concept, using your own money to pay back debt. But what that does is it leaves less money for public services and government programs. And then to cover these higher interest payments, they'll go ahead and they'll turn to you by way of higher taxation, leaving you with less money to spend on the things that you need and want. And then that slows down the economy by way of both businesses and individuals pulling back on their expenses, typically by hiring less people or, sadly, even laying people off. And that hits us all right at home. And speaking of hitting home, have you seen the new 0% lending program at Chase? I mean, if you have at least a 680 credit score with no collections and no bankruptcy in the last 7 years, Chase is offering 0% interest capital for your real estate investments and your business. And it's still running this program despite all of this inflation stuff. And I've been able to tap into this for my private clients and getting them up to $150,000. And they think I'm some sort of magician, but it's readily available to the public for now at nocostcapital.com. All right, so where was I? The Fed has to do this sketchy balancing trick to control inflation without causing, too much strain on the government's finances or triggering a recession. If they raise rates, then they slow down the economy. If they cut them, they stimulate the economy, but then that brings us more inflation, the very thing that we're trying to shrink, the thing we're trying to reduce. And inflation, it's been stubbornly high due to supply chain issues, increased demand post-pandemic, and geographical or geopolitical tensions affecting energy prices. That's what the government will tell you. And they're not necessarily lying, because these factors, they definitely play a role, but they don't paint the whole picture. And, people aren't dumb. They got eyes, they got ears, we got brains, right? And they can see that the real culprits behind the current inflation crisis are far more structural and policy-driven, like excessive government spending and the massive fiscal stimulus packages that have flooded the economy with money, significantly outpacing the production of goods and services. That's the very definition of inflation. There's just too much money chasing the goods and services. And this has caused a surge in demand fueled by unprecedented fiscal measures. And what that done is outstripped the supply, leading to higher prices really across the board. So despite the slight improvements in April, the Fed isn't convinced that inflation is tamed enough to warrant lower rates. So basically, the government's borrowing policies, the fiscal policy decisions, and the need to manage debt costs really complicate the Fed's efforts to control inflation. The target here is 2%, but the trajectory is really pointing in the opposite direction. And this delicate balance is why the Fed's decisions are so critical and why we need to be watching right now so we can stay in the know.
Wait.
What?
There is a wild card in play, however, and that is it's an election year. And historically, election years can have a significant impact on the Federal Reserve's policy decisions, although the Fed does strive to maintain its independence and avoid appearing politically motivated. But nonetheless, it's not a perfect system, because it is a system run by human beings who are susceptible to what all human beings are susceptible to, like greed, corruption, peer pressure, arrogance, or just plain old ignorance. Face it, human beings, we make mistakes. So you pick your favorite, but here are some key points to really consider. Number one, in an election year, the Fed's decisions are often under more intense scrutiny. There is a heightened sensitivity to how monetary policy decisions might affect the economy and, by extension, the voters' sentiments. Two, while the Fed is independent, political pressure can still be a factor. Presidents and other political leaders may publicly criticize or praise the Fed's actions, potentially influencing public perception and indirectly the Fed's approach. And then three, during election years, the Fed often adopts a more cautious stance, avoiding major policy shifts that could create, economic uncertainty.
Give me an example.
They may prefer to keep interest rates steady unless there is really compelling reasons to change them, such as, a sharp increase in inflation or a significant downturn in the economy. And so we're really close to both scenarios right now. They're both very possible in the short-term future. So an aggressive move in the coming months is definitely not out of the question. And with all that said, there is a number 4, and that's precedent. What's happened in the past? So in 1972, leading up to the election, President Richard Nixon pressured Fed Chairman Arthur Burns to maintain an easy monetary policy to boost the economy. And this resulted in lower interest rates and a win for Nixon. But it definitely contributed to inflationary pressures for the following decade. And then in 2000, the Fed Chairman, Alan Greenspan, maintained a steady course, gradually raising interest rates to curb inflation without causing significant market disruptions. And then, we remember this, in 2020, the Fed, led by Jerome Powell, faced unprecedented challenges due to the COVID-19 pandemic. And despite it being an election year, the focus was on really providing economic stability through aggressive monetary easing and really unconventional measures, stuff we've never seen before. So take those moves how you want, but the Fed says they prioritize clear communication and transparency during election years. Now, the skeptic might argue that the Federal Reserve, despite being an independent institution, could still be influenced by political pressures, especially during election years. They may suggest that the Fed's communication and decisions could be, tailored to avoid controversy or to support the incumbent administration's economic policies. Others might point out that the Fed's communication is often filled with jargon and ambiguous language, which can be interpreted in various ways. This lack of clarity may be seen as a way for the Fed to maintain flexibility in its policies without really committing to a specific course of action. And then there's others, they would argue maybe that the Fed is selective and it's information that they do choose to share with the public during election years. Regardless of your take on the Fed, it does seem reasonable to question the timing of the Fed's announcements and consider that they are strategically planned to really minimize potential negative impacts on the election outcome. And just when you think you may have it all figured out, you could point to instances in the past where the Fed's actions or communications were inconsistent or lacked transparency, casting doubt on their commitment to other communication and transparency during election years. Now, these are all hypothetical counter-arguments to the intentions of the Fed, but there's probably at least a bit of truth in all of them. While the Fed aims to remain apolitical, it's well within reason that the election years do add a layer of complexity to the decisions that they make. So the Fed's actions leading up to this election will be and should be closely watched. At the end of the day, here's what most people want to know: how it's going to impact their ability to buy a home. And that gives us the big question: when will the Fed cut rates? Well, there are really two things that we need to watch. There's two things that will nudge the Fed to cut rates. One, when they are certain that inflation is under control and their trajectory is heading convincingly toward their target of 2%. Or two, when the economy takes a hit and its trajectory is convincingly headed towards a recession. Now, neither one of those situations are likely to occur by Wednesday. And according to the CME FedWatch tool, there's a 98.7% chance that they will neither lower rates nor raise them. So you can almost bet your life that they're standing still next week. Despite the Fed's inflation battle, it's been reaccelerating. January through March saw horrible inflation reports. April was slightly better, but not enough to trigger a rate cut. So the Federal Reserve's last meeting hinted at slowing the tightening process from $95 billion to $60 billion per month. And this is a huge shift that could mean easier money, boosting stocks and cryptos in subsequent meetings. But don't get too excited yet. The 10-year Treasury note is the key here, and it's directly tied to mortgage rates. So whatever it does, your mortgage rates will likely do. So just keep it simple and watch that. It's your best indicator of where mortgage rates are heading. If you're looking to buy a home, consider locking in your rate now before things change. And if you're wrong, hey, you'll have the benefit of refinancing at a lower rate while everyone else watches house prices rise. Thanks for watching. Take care.